Welcome everyone! Today we are going to explore the fascinating world of gold and unravel the reasons behind its recent rise in value. We'll dive into the factors that have been driving the price of gold up and why investors are flocking to it as a safe haven. So, without further ado, let's jump right in. One of the key factors behind the rise in gold prices is the global economic uncertainty. Many analysts are predicting a global economic recession, and some even say that we are already in a recession. As you may know, gold has been considered a safe haven asset for centuries. In times of economic turbulence, investors often turn to gold to protect their wealth. The ongoing trade tensions, geopolitical tensions, and sanctions against Russia have all contributed to a climate of uncertainty, causing investors to seek refuge in gold. But honestly, this alone cannot be the reasons for the sharp increase of the price of gold that we have seen in the last couple of months. Let's remember that gold bottomed out in November 2022 at $1,630 per ounce. And since then, gold has climbed until reaching and even shortly surpassing the previous all-time high of $2,060 per ounce the last week. So, what else apart from political and economic uncertainties has been propelling gold higher? Let's see. Undoubtedly, one of the reasons is that central banks around the world have been increasing their gold reserves, further driving up the demand and price of the precious metal. In fact, central banks have accumulated gold at the fastest pace on record in the first 2 months of 2023, according to a report by the World Gold Council. But why central banks are accumulating more gold? They must be seeing something in the horizon, certainly. They maybe are preparing for a global monetary reset or something of the sort, as the world is seeing more and more attempts to erode the status of the dollar as the undisputed world reserve currency. If the dollar is seen as possibly to be shaken, then gold definitely is an asset that countries and individuals want to own, as the ultimate store of value. Then of course, the archetypical reason for which gold is bought is its role as an inflation hedge. It means gold protects the savers and investors against the loss of purchasing power by inflation. We have seen that inflation has run wild in the last 2 years, since 2020. So in principle, if inflation goes up, the gold has to go up as a counter-reaction. However, if we look at the chart of gold most of the time in the last 2 years has not really responded well to the news of higher inflation. Why? Well, because it's not that simple. Markets are forward-looking, and hence markets very often do not see what happens next after the event, but look for what will happen next to the next event to the next event. That is to say, markets try to guess not the immediate future, but way further. So, coming back to the issue of the relation between gold and inflation, when the news of excessively high inflation made the headlines in the media, sophisticated investors thought that as a reaction to the high inflation, the central banks around the world, and especially the American Federal Reserve, would increase their interest rates. And how do interest rates hikes relate to the gold price? Well, when interest rates go up, investors tend to move their money from non-interest-bearing assets like gold to interest-bearing assets like bonds. This shift in demand typically causes the price of gold to drop. Conversely, when interest rates go down, investors flock back to gold, driving its price up. We can say that higher interest rates are kryptonite for the gold price. If interest rates go up, gold in short term tends to go down. Lower interest rates diminish the opportunity cost of holding gold, as it doesn't yield interest or dividends like other financial assets. The idea behind that is very simple. If people get a very safe reward for their money by just lending it to the government through a bond, then gold loses attractiveness because gold does not give any yield. 1 ounce of gold will be after 1 or 10 years still 1 ounce of gold. But $1,000 after 10 years of being loaned to the government can give you some additional money, which is the yield. However, even if the Federal Reserve was increasing interest rates, the real interest rates were still negative, which means that if after considering the yield gained by the money invested in a bond, investors would lose purchasing power, because inflation is higher than the interest rates. In that scenario, gold should be going up, not down. So why gold was going down in this first period of inflation? I believe it was because investors were thinking that the Federal Reserve still wasn't done with their plans of increasing interest rates. In other words, when interest rates were being brought up from basically 0% to 1, 2, or 3%, the market was thinking that it still would go up in the successive periods. The mantra was that it doesn't matter if inflation is high, and it doesn't matter if inflation is higher than the interest rates, because the Federal Reserve will kill the inflation with their resolute actions, hiking interest rates as high as necessary. So obviously, if people were convinced that the central banks would manage to rein the inflation, gold wouldn't be looking so attractive to them. So, what has changed now in this narrative? It seems obvious to me that the market has given up on the capacity of the central banks to tame inflation. People are slowly getting conditioned to think that they will have to live on a permanent basis with higher inflation rates than just 2%. In other words, we are transitioning to normalize high inflation for the next years. Indeed, while the Fed has been raising interest rates to combat rising inflation, some investors believe that these efforts may not be enough. They worry that inflation will continue to rise, eroding the value of their currency-based investments. In response, they are turning to gold as a store of value that is more resistant to inflation. Also, what has changed is that now interest rates reach the level of 5% in the United States, which has caused a lot of problems to the economy and especially to some regional banks. Some of them even going bankrupt. So the market doesn't expect the Federal Reserve is going to increase the interest rates anymore. The market thinks that this is it. We have reached the top of the interest rates for the moment. The Fed cannot risk to harm the economy with higher interest rates, and the inflation is still slightly higher than the interest rates. So, who has won the battle? The Fed or the inflation? I think the answer is that inflation has won. And this is what investors have finally realized, and that's why gold has been in a raging rally in the last months. Even if inflation may come down for a while, if we look at the previous experience of sticky inflation which happened during the decade of the 70s, it is clear to me that the nature of inflation is the one of coming in waves. It happened in the 70s, and it will probably happen again in the coming years, as a kind of re-edition of inflation reading decade. Apart from that, I would like to mention that from the point of the supply, gold has reached probably its peak. In the last few years, there have not been big investments in developing new gold deposits. Gold mining companies were very disciplined with their finances, avoiding big and expensive projects. Their main goal and motto focused on making their businesses profitable. Many gold companies got short in the last bear market of gold after it peaked in 2011. Many projects in which gold companies burned huge amounts of money became unprofitable as gold went as low as $1,000 per ounce. So, now gold supply is constrained. While demand has been always there and central banks are not anymore net sellers, but net buyers of gold. We can also add one more reason, which is the weakness of the US dollar in the last months. If we look at the DXY chart, we can see that it has fallen from its peak of October 2022. So basically, that period of weakness of the US has coincided with the strength of gold. However, this is a factor which plays in the short term. In the long term, there is zero correlation between the DXY and the gold price, because after all, the DXY is an index that measures the US dollar against other fiat currencies, like euros, yens, etc. So if all fiat currencies are falling in purchasing power against real consuming goods, the only information that DXY gives us is how much faster a currency is falling in purchasing power when compared with other currencies which are also falling in purchasing power. The only long-term correlation between gold and the US dollar is the chart showing how many dollars you need to buy your supermarket basket of products and gold price. The purchasing power of dollar is long-term going lower and lower, while gold is long-term going higher and higher when measured in dollars. In the long term, gold always manages to reflect the erosion of purchasing power of the currency as the central banks inflate the monetary supply by printing money as a consequence of the budgetary deficits of the countries. Hence, although in the short term gold may look like not reasonable with regards to what happens in the economy, in the long term it really does its work of protecting the purchasing power of gold owners. There can be many other factors influencing the gold price, for sure, but I would say that the ones I have mentioned are the most important ones. So to sum up, strap in for a new bull gold market, in my opinion. Gold may very likely soon break out the all-time high resistance and rise up to a new all-time highs around $2,300 or $2,500, according to some experts and according to my own view. After all, gold has a lot to catch up still with all the amount of money that was printed in the COVID crisis between 2020 and 2021. As said, gold may be slow to react, but in the end, gold does very well its job of accounting for all the currency debasement operated by the quantitative easing programs of the central banks around the world. Of course, this is not financial advice, and you should consider this only as my opinion. It is your full responsibility what you do with your money. That's it for today. See you in the next video.